Sonal Varma, India economist at Nomura Financial Advisory, joins in. Sonal, this definitely looks better than anyone expected.
Yes, definitely, and I think most of us were expecting in any case CPI to be down because of the base effects, but I think even adjusting for the base effect, the momentum is significantly weak. One of the things that we track is a trimmed mean measure of CPI, which sort of gives a good indicator of the underlying CPI, and that number actually is at around 6.2% in September. So, just to put it in perspective, this number was close to 7% last month and has been in the 8 to 9% range for most of last 1 year. So the underlying momentum actually in CPI has come down between 6.5%, which I think has been much better than what anyone had expected in terms of the underlying momentum.
What is the trimmed mean CPI, if you can tell us in lay terms?
In lay terms, I think, when one is trying to understand core CPI, typically we tend to remove the food and fuel basket. What the trim mean measure does is basically remove the 10% of very high and very low inflation components, irrespective of it may be food, it may be fuel. So what is the inflation rate in the 80% of the median basket, which is sort of an indicator of underlying inflation.
Thank God you asked that question, Lata. I thought I was the only uninformed person who didn't know what trim mean CPI was. But Sonal, hi, morning. There was a significant cool-off in the food inflation this time around, and that's a big relief. Do you expect food inflation to continue to trend at this 7% level, or was this just an aberration?
No, again, food inflation is where the base effects were going to kick in because of the vegetable price, which had gone up last year and had gone down this year. But I think the big surprise in food was cereal price inflation, where again there was a big moderation in the underlying momentum. So I think the impact of lower minimum support prices, as well as the destocking that the government has done, which has sort of cooled down market prices, that is starting to reflect in CPI. And I think broadly our view would be that food price inflation should be under check, primarily because some of the protein food inflation, which is where we've seen sort of stickiness in food prices, they are to an extent also driven by rural wages, because they determine the cost of the protein price inflation. And the latest data we have on rural wages, our estimate is that it's come down to single digits now. So cost of production on the food side is coming down, which should be good news for protein food. Cereal price inflation under check because of lower MSPs. Global food prices like sugar, edible oil, pulses under check. So the only volatility in food inflation is being caused by fruit and veggies, which honestly we don't know how it's going to move. But the broad trend in food inflation should be under check.
Oh, absolutely, and it's a 15% weight in the CPI itself, and the cereal inflation falling is coming at a time when actually the kharif should have been worse and inflation expectations should have gone through the roof. So, Sonal, what is the longer-term trajectory? Have we finally won that victory over food inflation, especially the demand-related impulses coming from rural wages and MSP spiral, as you pointed out? What's the trajectory 12 months down the line and for that big date of January 2016?
So in terms of the overall CPI, like I said, the underlying CPI is already between 6 to 6.5%, and therefore yesterday's release does have significant bearing on the future outlook for CPI, and our inflation projections actually sort of trend down by about 50 basis points. So we were expecting inflation to basically rebound to around 7.5 in Q1 2015, which now looks more like 6.5, 7, and we were expecting 6% by Q1 2016, which now looks like it will be met sometime of middle of 2015. So I think clearly the Jan 16 target of 6% looks very much achievable, which in any case was our view that it's going to be achieved. The difference is in terms of the timing, and now looks like we'll be able to achieve that much faster. I think the key question really is what happens when the growth cycle picks up. and what is the impact that that has on inflation, because as far as the next 6 to 12 months is concerned, our view is that broadly inflation should be under control, and we should be closer to 6% in the next 12 months time frame. The question is, looking beyond 2015 into 2016, when the growth cycle starts to pick up, whether we will see inflation sort of resurge or not, and therefore what is the outlook for monetary policy.
That's actually my next question. I'm sure Governor Rajan will be very pleased to see these numbers, but are we staring at a rate cut anytime soon?
Anytime soon, no. One of the considerations implicitly in our view that is in the RBI's mind is the Fed cycle, and we are unlikely to have clear certainty on that in the first half of 2015, so we are not expecting any rate cut. After yesterday's release, we have increased the probability to a rate cut in the second half of 2015 calendar year to 20%, but our baseline is still for rate cuts to happen in 2016. And I think one of the key things that we need to watch out for is the medium-term inflation target that the RBI and the government set. Most reports suggest that sometime in the next 3 months, a monetary policy framework agreement will be signed between the government and the RBI. What we don't know is what that medium-term target will be. RBI committee had recommended 4%. I mean, this number could be 4, could be 5, but it would be surprising if they set 6% as a medium target. Therefore, beyond this 6% target, our sense is that the RBI will set a CPI target of between 4 to 5 from a medium-term perspective. And if that is the direction in which we are moving, then probably RBI is going to stand pat through the course of 2015 as well. So that's the key, even to watch out for in the near term. The view on inflation is very positive, but I think the view on RBI policy rates for now doesn't change. But I think, in this macro environment where inflation is coming down, real rates are turning positive. From a banking system interest rate and banking system liquidity perspective, this is clearly also a big positive.
Okay, so you would look at even the 10-year yield at closer to 7% in a year?
Not closer to 7, Lata, because we are not anticipating a rate cut right now, but definitely, going down closer to around 8, 10 or so in a year's time.
Okay. There are gains to be made in buying bonds then. The downside of this bright inflation story is the downside in growth. IIP numbers were disheartening. JP Morgan is already calling for a 5.1% GDP. They were the only ones who have so far downgraded. What are your numbers? Do you think that they are at risk at being downgraded?
I think, we need to be clear about the trend. And I think, the trend in the growth cycle is now higher. IIP is known to be extremely volatile, and therefore we are looking at a host of other real activity indicators, whether it's demand for cement, which is an indication of construction activity, discretionary demand, which is basically your car and two-wheelers, an indicator of manufacturing cycles, which is your MHCV, the medium and heavy commercial vehicle production, railway freight traffic. A lot of these indicators are now turning in the green and on a sustained basis. And therefore, to question the trend in the growth cycle at this stage, I think it's, a bit too soon. The baseline view, in our view, is still for a pickup in the growth cycle. Having said that, I think after the big pickup in momentum in the June quarter, there is now clearly a payback in the September quarter, and therefore after the IP reading, the September quarter GDP is tracking around 5.2 or 5.3%, and our base case is about 5.8. So there will be some downward impact on GDP for the full year based on this. But like I said, the growth numbers are still going from 4.7 to somewhere still above 5.5%. I don't think GDP numbers for this year should be under 5.5%. The trend still looks to be on the upside, so that view doesn't change.
Okay, and FY16 growth?
FY16 growth, we are building slightly above 6.5%, and at this stage still comfortable with that. Remember, agriculture is also going to see a sharp rebound in FY16, which will be positive even for rural demand.
Point taken. Sona, I just wanted to get that trend that at long last probably GDP will be higher than inflation in FY16. Probably. Thank you very much for joining us with all that.